Welcome to Talk Tickers. Today, we are digging into Petco's absolutely pivotal third quarter earnings call. And let me tell you, this report sent a real shockwave through the market. So, let's just jump right in and see what all the fuss is about. Now, that shockwave looked like this, a massive 14.5% jump in the stock in just one day. So you gotta ask, right? What on earth did Petco's management say on that call to get investors that excited?
Well, it all started with this absolute monster of a headline number, a staggering 400% beat on adjusted earnings per share. You know, Wall Street was expecting a single penny, just 1 cent. And what did Petco deliver? 5 cents. Look, a beat this big, it's no accident. This is a huge signal that something fundamental is changing inside the company.
Okay, so how exactly did they pull this off? What's so fascinating, and what I think the market really keyed in on, is that this wasn't some story about a huge surge in demand. Nope, this was a masterclass in financial discipline. It was a very deliberate choice to focus on earning more, not just selling more.
And this slide right here, this is the whole story in a nutshell. It's the core trade-off. Over on the left, you can see revenue was actually down. Comps were negative. They sold less stuff. But, and this is the big but, look at the right, the real story. Adjusted EBITDA, a key profitability metric, was up a whopping 21%. Margins just exploded higher. It's clear what happened. Management deliberately walked away from unprofitable sales to absolutely supercharge their bottom line.
So how'd they do it? It's actually pretty simple, in a way. They got back to basics, back to retail fundamentals. They just tightened the screws on everything. We're talking smarter pricing, way fewer of those empty calorie promotions that don't make any money, really strict cost controls, and look at this, a huge 10.5% cut in inventory. This is just good old-fashioned blocking and tackling, and man, it is clearly working for them. Now, it's really important to understand that this wasn't just some one-off good quarter. Not at all. Management was super clear on the call that this is just the first step in a very deliberate multi-year plan. They're calling it Phase 2 of their transformation, and the mantra is simple. Rebuild the foundation first, then go chase growth.
And you don't have to take my word for it. Here it is, straight from the CEO. This is the mission statement. The message couldn't be clearer. Let's fix the economic engine of this business right now. Let's strengthen our foundation. And then, and only then, we'll use that solid base to pivot back to aggressive growth. They're even circling 2026 on the calendar as the target.
So what does that future growth actually look like? Well, here's the playbook. It's built on these 4 key pillars, all designed to get that top line firing again once the profit engine is humming. You've got unique products, a better in-store experience, scaling up their high-margin services like vet and grooming, and then tying it all together with a new membership program. It's a pretty comprehensive plan. All right, so management's laid out their plan, but what does the market think? How is Wall Street actually interpreting this strategy? Because that initial 14% pop, well, it really doesn't tell the whole story. The reaction is actually a lot more nuanced than you'd think.
First things first, the interest was just enormous. Take a look at the trading volume. It exploded to nearly 6 times the daily average. This wasn't some minor move by a few traders. No, this was a massive reevaluation of the company by a whole lot of investors who basically woke up and took notice.
But, and this is a big but, we have to put that pop into context. Just look at this timeline. Even after that awesome 14.5% jump, the stock is still down a painful 38% over the last year. And that right there is the crucial point. The market absolutely loves this newfound profitability, but it is still deeply, deeply skeptical and basically saying, show me the money, show me proof that you can actually grow again.
Which of course brings us to the million-dollar question. What happens next? Well, here at Talk Tickers, we've got a take. Let's call it our outrageous but plausible thesis for what's coming in the next earnings call.
Think about it. Management has already proven they can control costs. They've proven they can expand margins. Okay, check. The market gets that story now. So the next big catalyst, the next big surprise, it has to come from the top line. It has to be about growth.
So here it is. This is our official Talk Tickers call. Right now, management is guiding for another quarter of declining sales. They're telling everyone to expect sales to go down again. But we're predicting they're going to beat that. We think they're going to post positive comparable sales for the first time in this whole cycle. Why? Because we think the early traction from their new plans, plus the fact that they're lapping some store closures from last year, is going to be just enough to create a surprise. And if that happens, Well, man, that validates the entire turnaround story. The market, which is still stuck on this being a no-growth company, would be totally forced to re-rate the stock. We think that could trigger another 10 to 15% jump, and for that reason, we are rating the stock outperform and heading into the next report.
And of course, this is not financial advice.